So those assets we see on the balance sheet, we're looking at them from a book value perspective. Do you know when the assets on the balance sheet may reflect market value rather than book value? There's two points in time. When might that be? Carol, any idea? David?
If they're held for resale?
Possible, in which case they would be some of the current assets rather than the fixed assets because they'd be part of our inventory, right, David? But so if they're held for resale, then we're thinking about them differently. We're thinking about them as inventory. What else? How about the moment that we acquire them? The moment at which we acquire the asset, the book value is the market value, right? We haven't had any time to depreciate it yet. And then there's one other. Do any of you know the term mark-to-market accounting? Mark-to-market. Matt, you're familiar with the term?
I don't know what it means, but I'm familiar with the term. I remember talking about it in my accounting in undergrad, and it's been a while.
It's okay, and you might remember us discussing it in your 603 class as well. So let's assume for a moment that I have a business that meets certain criteria with the in terms of asset size and revenues as established by the IRS and is by FASB, the Financial Accounting Standards Board, FASB, FASB. And FASB sets GAAP, Generally Accepted Accounting Principles, GAAP, GAAP. Well, under those constructs, a company of a certain size is either required to or possibly only allowed to mark its assets to their market value each year as it reports their balance sheet. So let's assume for a moment that Shenzhen has a building in Pittsburgh that he has acquired, and it sits on the balance sheet of the company. And we know that he acquired it for $5 million, but its market value today happens to be $7 million. Well, if his company meets certain criteria, he is allowed to mark that value on the balance sheet up to its market value, which means he's allowed to take a $2 million improvement to the balance sheet. So let's look at the balance sheet for just a moment to understand the effect of this. Let's say that it's this piece of real estate right here, and I showed it 22.31, when in fact it's actually worth 24.31. It's got a $2 million market value improvement. So I'm going to change that here for a moment. You're going to see us come out of balance, 24.31. And all of a sudden you're going to note that immediately our balance sheet no longer balances by $2 million. Okay? So how does this come into balance? Well, we would then also take a $2 million income or revenue benefit over on the income statement. I'm just going to throw it into one of these categories just because I don't want to change this thing up. I'm going to go from 1.86 here in the revenue for private equity. And I wouldn't normally put this in private equity. I normally have its own category. I just don't want to do that much manipulation of the spreadsheet while we're here today. But I've got to find a way to include that $2 million of enhanced value on the income statement. So I'm going to put this into one of my revenue lines, and we'll go ahead and put it in here at 3.86. And you'll notice that all of a sudden, I'm almost in balance. Not quite. And the reason I'm not quite is because of taxes down here. If I made an appropriate adjustment for taxes, I would then come into balance. So effectively what happens is when we take that extra $2 million, we mark it up on the balance sheet, we get to recognize that income. And we recognize it somewhere on the balance sheet or on the income statement as a tax adjusted amount, and it's going to then increase our accumulated retained earnings. Because notice what happened here. Let me put this back to 1.86. Look at accumulated retained earnings. Right now it's 104.658. When I take this back to 1.86, that declines by almost $2 million. because our retained earnings here changed by that dollar amount, okay? Well, let me put this back where it belongs. Okay, there we go. So when we mark up an asset on the balance sheet, we mark it to its market value, it increases our retained earnings because we added some income for which there was no corresponding expense. And you might suppose accurately that it also we would have seen that same increase in free cash flow. And under the premise that an asset's value is the time discounted future expected free cash flows, having done so, marked up some of our assets, increased the value of the company. Well, the problem is that Shenzhen did that this year, or let's say he did it 2 years ago. He took that improvement. It increased his free cash flow. That did increase the value of the asset to anybody that's looking at the asset. In fact, it was his production value. Because what does the company produce for us as investors? It produces cash flow. For consumers, it might produce cars or widgets or software or shoes, but for us as business owners, investors, it produces cash flow. Well, what goes up, sadly, we know, has the opportunity and ability to go down. So let's say that Shenzhen was doing this coming into the financial crisis of 2008, and he'd been marking these things up on the balance sheet because every year his real estate was worth more and more, and then the financial markets and the real estate markets took a tumble. And when they did so, Shenzhen had to go ahead at that point and mark them to market on the downside. And the dynamics of change on the upside are equaled by the dynamics of change on the downside. So gives us a clue as to some of what happens in the balance sheet when we're thinking about the book value of invested capital versus the market value of invested capital. For our purposes, we won't be dealing with a debate over whether or not the company we're looking at has marked up these or marked them down to the market values or not. We will simply accept the book values as those fixed asset values we can use in the invested capital operations approach. We're not going to worry about whether we've employed mark-to-market accounting. And the only reason that I go into that little diatribe about mark-to-market accounting is because it'll help you correlate some things with your accounting classes and will help you understand some of the dynamics of financial crises or jubilation like we had in the years coming up to the financial crisis, in which case a lot of the market expansion was a function of mark-to-market accounting, and why we saw such a precipitous decline when those real estate and equity values started to fall, because that then created this cascading effect or a funnel spiral downwards for any company that had been marking up their assets, now had to mark them down. By the way, this is why so many of the big banks ended up insolvent, because they didn't have real additional cash flow. They had kind of phantom cash flow from mark-to-market accounting principles. So we can look at our invested capital and we can think about return on invested capital. We know that that's no plat divided by invested capital. And we remember that no plat is simply operating income or EBIT times 1 minus the tax rate. So this gives us some return on invested capital. That's going to be more important to us a little bit later on, but it's important to know where ROIC comes from. And now let's take a look at that pesky G. Before we do so, any questions that you might have with respect to what I've talked about so far? I didn't think you would, but I'm going to encourage you to start getting enough more comfortable with each other and with me so that you're actually willing to ask questions.
I have a question.
Oh, bless your heart. Thank you.
So what would make a company have to do that mark-to-market value? Like what?
So good question, Bella. That was Bella, right?
Yeah.
Yeah, so good question. One of a couple of things. Either the company meets the FASB and GAAP conditions and parameters that requires them to, which I'll go into in just a moment, a little bit of those. I don't want to go too deeply there. Or it has a pattern of having done so, in which case it has to continue to do so. Okay? So here's an example. Let's say that Bella Enterprises owned a minority stake in Michael Allen Incorporated. So it owns 30% of Michael Allen Incorporated. Because it's a minority stake and you don't control the company, Bella, then you would have to mark up that asset on the balance sheet or mark it down to its market value because you own a minority stake, assuming that your gross revenues are less than $10 million a year. If they're over $10 million a year, then you start to have some choices. But that then is a function of how the IRS has ruled on the kind of industry and the assets that you have, and how that's reflected through FASB and GAAP. Kind of wish you hadn't asked now, don't you?
Well, because I always wondered why many businesses or self-owned businesses always put like cars under the businesses or like landscape or real estate.
Yeah.
I just wondered why they would do that.
So that's actually a different issue. So oftentimes a business owner will have their automobiles they have for personal use under the company's asset umbrella, so on the balance sheet, for the tax write-off, not for accounting of invested capital and such. And it's a whole different set of parameters to help us understand when we have to depreciate assets and when we don't. That's more the purview of your accounting 603 or your finance 603 class, and gets into some detail that you may not want to get into or is not all that relevant for this class. But that's why they do so. You know, you can suppose that even though I'm a full-time professor at Westminster, because of my background in having owned my own companies for about 30 years, I still own a business shell, and that business shell still owns assets that frankly are there only because of my personal utility in them. But I keep them there for tax benefit and sometimes for liability protection.
Got it. Thank you.
So when people put cars for the tax write-off, how can they prove that they use that for business and not just for themselves?
Well, good question. So they have to, technically, if you're proving this, Diana, you need to keep logs and maintenance records and such that evidence its utility for the business. If it's a car that could have been used by you for personal use. Now, if it's a great big dump truck, rarely do people question it, right? But if it's your Cadillac or your Buick or your Nissan, then it may easily be questioned. So there are logs that should be kept, but then also you have to question how customary is it that businesses do this, and will the IRS even ask? And it's a very unusual scenario in which the IRS is going to ask a question like that. Now, if I've got me and my wife and a partner as the owners of a business, and we're the only employees of the business, and we each have our Mercedes and our BMWs in here, and I also have my Bugatti and my Porsche, then maybe the IRS is going to ask, because I'm not taking the Bugatti out on the road. Now, those of you that saw my Bugatti the other night understand the joke. It's a model. It's a 1/18th model. You couldn't put my left foot in it well enough the rest of my body. Okay?
So on the mark to market, one question I have, Rick, is, so it sounds like they were, you know, there's certain reasons, right, that we've kind of just discussed why you would use that accounting method. But it sounds like some of those companies during the financial crisis were doing it to maybe not necessarily prop up, but just like a lot of accounting practices, you try to use methods that make your financial statements look as attractive as possible.
Absolutely.
So I would imagine that's why they were doing it. Was there any type of, if that was a contributing factor though to why, you know, then they had to mark things down and made their assets less valuable, potentially even considered toxic, was there any type of regulatory crackdown on using that practice of accounting as a result of that kind of tidal wave?
Yeah, we call it the Dodd-Frank Act.
So it is part of Dodd-Frank. Okay.
Absolutely. There's even reference to it in SOX, so Sarbanes-Oxley. You bet. And then one of the other disclosure acts as well, the name of which is escaping me at the moment. But absolutely. And essentially those acts suggest or state that if you're doing so, you must disclose that you're doing it, and you must do it consistently, and you must have an outside evaluator evaluate the market value. So you can't simply be self-serving.
Gotcha.
Yep.
Okay.
Good question. Well, let's talk about growth for a minute. This G, this little nemesis G. We're going to separate growth out into two time frames. We'll have what I most often refer to as an explicit period of time, and then what I call a continuation period. Sometimes in the various finance literatures, you'll see these referred to as discrete time or express time or explicit time. Those are all synonymous terms for this purpose. And then separately is this continuation or terminal period of time. So let me separate those out contextually for you. If Andrew and I are sitting down looking at what we think the company's growth pattern is going to be for the next 3 to 5 years, we believe that we can relatively accurately project that. We're going to look at our customer orders. We're going to look at the innovations coming through our new product lines. We're going to look at the macroeconomics. We're going to look at our other growth plans. We're going to look at all these different factors. And we're going to say in the year 2021, we believe we're going to grow at 12%. And then we're going to do the exact same thing for the year 2022. And maybe we decide we're going to grow at 11%, having taken all of these inputs and using the best information at our disposal, including what our industry growth pattern should be and what our own company growth pattern should be and what our goals are. Well, we can do this for this year, and we can do it for next year. And I can do it for yet the next year still. But I liken this to walking out on a lake that's frozen over with ice. Every step we get closer to the middle of the lake, the ice gets a little bit thinner, right? I'm going to say in the first 3 to 5 feet from the shore, assuming it's cold enough, that the ice is thick enough that it'll support my weight, Andrew's weight, and 20 of us standing right next to each other. But I'm not even sure I would stand alone well enough next to Andrew and anybody else if I go yet 20 more feet out towards the middle of that. Starting to get a little shiny. I think I can even see a wet spot. So the further we go from right now, the less credible our growth assumptions become because we suffer from not knowing what we don't know. Now, I think that all makes good sense to you, right? I know with great clarity what's going to happen in 1 second. Well, now it's already happened, so I was right, okay? But I have no concept of what's going to happen in 20 years. Oh, I will be, well, I might be older. I might be dead. You guys will probably all be older. But 20 years from now, I'm not buying ripe bananas, okay? This isn't going to happen, okay?
Also, even in a year, because who thought of this pandemic? Who thought it's gonna be here?
Thank you, Diana. That's a really good point. Now, we would have bet a year ago that we wouldn't have had a pandemic. Sadly, we would have been wrong because even though sometimes we are very certain and we have lots of reason for our certainty, sometimes we're even still wrong then. But we certainly wouldn't bet that over a 20 or 30 year time, there wouldn't be a major health catastrophe that would beset our globe. Certainly not today, right? So those are examples of the explicit, express, or discrete time. That period of time in which we think we can comfortably, credibly, and confidently forecast out our company's revenues and expenses. And the further we go along that time compendium, the less accurate we become till we get to a point where we say, we're not willing to venture beyond this point, okay? That then takes us into this continuation. And I will tell you that even if Andrew and we brought Matt and Shenzhen into this discussion, the best minds in our company, we would say if we're looking at forecasting what growth is going to look like in 20 years, we're going to have to confess that if we're growing in 20 years, we're probably only growing at the same rate of overall economic growth for the entire economy, which typically is pegged at somewhere between 2 and 3%. Okay? Well.
Rick?
Yes.
So in order to do these predictions, you usually look at the past, correct? The history, but how far do you go back? Like, what is a good range to start, like, because you might not want to go too back in the past, but you might want to in a range of what, 5 years or 10 years, or the more information you have, the better it is?
So Andrew, next week we're going to go into this with some greater detail as we talk about how we forecast, but you're exactly right. I might look at the last 2 to 5 years, assuming the management team today is similar to it was over the last 2 to 5 years, assuming the macroeconomic conditions, assuming we have the same company structure. But every time I add assumption to that, I'm doing some exponential guesswork, right? So I'm very careful about my past, but if I am ignoring my company's past, I'm equally as foolish if I'm being too aggressive with it, right? Yeah, good point. Very good point. So we're going to think about the explicit period as having a growth rate that we can probably generalize and get our hands on. And it's going to be a function of a variety of inputs that we'll talk about next week. So here we are, and we're starting to do some of that. And Bella happens to be the president of the company, CEO. And Bella, you've been with us for about 10 years. You have led us through a great period of growth. We are proud of you. We've become wealthy because of you. We, by the way, are the board of directors, and we are the majority shareholders of the company. We're so grateful, and we have given you a very nice exit package because you've now decided it's time for you to retire. And so thank you very much. You've made us all wealthy. You've given us double-digit growth for the last 10 years. And as it turns out, Jason, Mario, and Taylor are the 3 applicants or candidates for your position to replace you. Jason, we're now having this interview. Are you going to be able to deliver the same kind of growth for us in the next 10 years that Bella has delivered in the last 10? You're applying for the position. You want this job.
More growth.
Yeah, you're certainly not going to be less than Bella, right? Unless there's some overall economic conditions that you have to be subject to, right? And as it turns out, you're going to presume that you'll have that kind of growth. In fact, there's all these reasons that we have all sat down and agreed upon why you may get that. Fine. So we've got 10 years of good growth from Bella. We now have 10 more years to look forward to because Jason's now our CEO. And 10 more years goes by. Taylor's gotten 10 years older in the process. Jason is retiring. We now need to find somebody to replace him. And it's Mario and Shenjiang and Taylor that are applying for the position. They're candidates. Mario, are you going to be able to give us, again, you're in an interview here with the board, are you going to be able to give us the kind of growth that we have, this heritage of growth for having gotten for the last 20 or 30 years? Will you be able to deliver that to us as well?
I'll say that at the interview, but I think that, as the company grows and matures, you can't expect that type of growth continually. So I don't know.
Oh, okay. So are you suggesting that Jason and Bella were better managers than you?
I'm suggesting that they probably had a greater opportunity for growth than I did.
Had better opportunity. Boy, that sounds like an excuse to me. Taylor, how would you get my point? And we can keep playing this game, and we can forward ourselves through this decade after decade, century after century. We can argue that we should have this entire path runway in front of us of double-digit growth. And we would argue ourselves into ridiculum because we not only have no examples of it having lasted for more than a couple of decades for any credible firm, but we just know it doesn't make intuitive sense. So on one hand, we can sit here and we can academically, intellectually argue for virtually infinite, long, or really high-level growth. But simultaneously, we would have to argue that it's implausible, and we've never observed it. It doesn't pass the smell test. So you now understand why G, as a singular variable, is my nemesis. It brings out the schizophrenic in me. I can argue both sides of its coin. That said, you will use a long run or perpetual growth rate of somewhere between 2 and 3%, depending upon the type of industry that we're talking about. Why 2 to 3%? because that's the range in which economic growth has tended to exist for this and other similar economies for the last couple of hundred years up until about the point that the Industrial Revolution took hold. Okay?
So, question real quick, Rick. So it sounds like that was one of the questions we came up with in our homework.
Right.
Was why 2.5%? And it sounds like, I think the answer initially was, well, that's kind of just the assumption for the calculation, but it sounds like that's based on a really historical benchmark or baseline. My question is, as far as like how many years you project out, the whole conversation we just had, which is obviously the further you try to project out, the less variables you can account for, or the hazier it can get. And Damodaran kind of referred to this in one of his videos about some Tesla evaluation and how they had something about, and I'm trying to remember, and I guess my question is, how many years would you typically, project? Like, is there any type of standard assumption for that? Like 2 years, 3 years? Because I think in his example, he was saying that after 5 years, they just kept it at 6%, and he just thought that was ridiculous because, to your point, eventually the growth it'd have to be like, it'd have to take up a portion of the economy significantly to be that high. So I'm just wondering, is there any standard amount of years that you project or that in practical terms in business that businesses project?
That's a really good question, and I will tell you that there's probably a standard range, Matt. So Damodaran in one of his videos also indicated that if you can get a good, solid story and picture of the company by only projecting out 1 year, then that would be his preference. So he projects out as few years as is necessary to get a good vision of the company and tells the company's story, okay? Myself, I am hard put to project out past 5 years unless there's some reason to. Let's say, for example, that I'm a pharmaceutical concern and I have products in the pipeline that I have very good reason to believe will come out of the approval process. Let's say we're in FDA stages for approval process, come out in 2 years, and I know that I've got a patent that's going to last me another 10 years, and that I'll have a virtual monopoly on this. Well, that might be a reason that I might project out a little bit past 5 years. Or the one I like better still, and you're going to see this company here in a few weeks by the name of Pascal Enterprises, I think is the name of it, where the company has a series of federal contracts that run 7 to 10 years. Well, if I've got a federal contract, those are good as gold, and I'm willing to project out maybe 7 to 10 years if those are in my future, if they are known to me today. More often than not, I'm a 3 to 5 year guy. Okay, and I hope that that's sufficient for you to get your head around this. Let's talk for a moment about why I attach perpetual or infinity, maybe forever, to the possible growth. If we get to the point, or rather when we get to the point of talking about the Gordon growth model, you'll find that part of that model makes the assumption that the company's growth will be perpetual. Is that a credible assumption, or is that an outlandish assumption? What do you think? Kylie,
it's just an operating assumption, right? Like, don't you have to operate under that assumption?
Okay, but how can I? Show me an asset or show me a business that has been around forever or that we think is going to be around forever, because that's what infinity means, forever. Kylie, what do you think? Plausible or doesn't pass the smell test?
I don't really think it's plausible, just because you can't predict the future. So you can't promise to be around forever.
Yeah. However, I'm going to get metaphysical for a minute because even finance gets metaphysical, okay? So let's say that I've got a company and it's a printing press, and I use printing presses because it's a printing company. And these printing presses are large, multi-million-dollar machines that include lots of actual tangible hardware and maybe some intangible software. So I know that there's a 7-year depreciation schedule on my printing presses. So after a 7-year period of time, I've depreciated them down to 0. However, and that's on the balance sheet. However, I know that if I've been maintaining them well enough, that I probably have numerous years, excuse me, I apologize for that. I have numerous years of life in that printing press. So maybe I'm actually going to get 15 years out of the printing press. But even at the 15-year mark, I'm not going to use it any longer in my business. Maybe at that point I sell it to, maybe I sell it to Lisa's business, because Lisa's got a lesser quality printing business than I do. They don't do the volume, and she's fine with a 15-year-old printing press, whereas my customers won't put up with a 15-year-old printing press's output. So I was able to get something when I sold it to you, Lisa. You bought it for some dollar amount, right? You just nod your head. Yeah. And now Lisa uses it for 15 years. She's been willing to maintain it very well. But 15 years down the line, now this thing's 30 years old. And I'm here to tell you a 30-year-old printing press probably has no realistic, useful, productive life as a printing press. It, however, has been for 30 years printing material, and maybe just because of price increases, if nothing else, we've been able to see a growth in revenue from what it has produced for us. But now it's 30 years old. And Lisa doesn't sell it to some other company to use. Lisa sells it to Bella. And Bella owns the scrap yard out there in Lehigh. And the printing press now goes out to the scrap yard and ends up getting smushed into a cylinder and ends up going out to Geneva Steel, or whatever that's called this decade, and it gets melted down, and pretty quickly it shows up in an I-beam inside of a new factory that Andrew is building. Does that I-beam have a productive purpose for you, Andrew? Sure, you couldn't build your warehouse without one, right? And so we might even be able to attribute a little bit of the productivity of your company to that I-beam. The asset, the physical, tangible asset, may morph in its utility. It may morph in its ownership. But unless you know something about black holes and matter that I do not, that asset will continue to exist. And so we say that it has a perpetual life. It does stretch the imagination though, doesn't it, Kylie? Yeah. Just recognize that that rationale is why the imagination can be plausibly stretched. And when we get to the Gordon growth model, we will talk about G as a perpetual value. So this continuation term, or this terminal term growth rate, is a growth we will apply on a perpetual basis, because we have some underlying foundation for that, even though it does stretch the imagination. Does that make sense? Good, I hope so. Well, let's look at some numbers. And we went through some of these numbers a few minutes ago. I'll take us back there again. I'm seeing something that is concerning me here. Bear with me a moment. I'm seeing 130.668 for invested capital when I think that I have on here 145.468. The reason for that is I have a slightly different update on these numbers that I didn't transfer into my PowerPoint. I'll apologize for that. I will update the PowerPoint in a few hours and repost it for you. But here I'm simply looking at Mira Giovanna for its updated values for the operations approach and the financing approach. Here, this would have been the fixed asset value. This would have been the current assets, and this would have been the current liabilities. So it would have given me then this 130.668. Down here in the second approach, the financing approach, this would have been the long-term debt, and this would have been the total equity, again, resulting in the same number. Here you might remember that from the prior year, and again, these are not correlated immediately with the marriage volume numbers because of an update done in them. We've got no plat divided by invested capital that resulted in a 17.59% return on invested capital. And we get to see some dynamic growth numbers here in that 2 to 3% category. Any questions about these at the moment? Okay. Well, I want to get past something here real quick. I don't want to spend too much time on the numbers here. I want to talk about the concept of opportunity cost. We may come back to these numbers. I want to talk about the concept of opportunity cost. So I will tell you that in my business, we've been running this business for the last 3 years. Matt walked in. Actually, we've only been running for the last year. Matt walked in. He's the CFO of the company. And he said, Rick, congratulations. Here you have this new business. It's only a year old. And you had a net income or a profit. That's what we normally think of profit. That had a net income of $100,000 this year. Congratulations. Almost no business has a first-year profit of $100,000. I, in turn, hang my head on the table and start to weep uncontrollably. How come? What's going on there that causes me to be so disappointed by a $100,000 profit after my first year of business? Any ideas?
Maybe when you spend more on business, more than 100, you didn't get, like, not on the paper, but in real life, maybe when you spend more money.
Yeah, how much did you invest in it?
Yeah, or how much time?
And Matt, is that where you were headed?
Well, what did you forego? Like, did you miss all your kids' soccer games, and did you have another investment opportunity that you thought you could have got $500,000 out of? I mean,
yeah. So let's talk about those because Mandy's comment, Matt, and yours are correlated with each other. So what did I give up, Matt? Well, I invested $2 million into this business. And so I gave up the use of that $2 million. And at worst, I could have invested that $2 million in some treasury instruments or maybe in some certificates of deposit and gotten, what, 2% from it? So I think 2% on $2 million is $40,000, okay? So there's $40,000 of interest earnings that I gave up by investing this in the business I could have gotten had I invested in the CDs, something as safe as the day is long, okay? Also, by the way, I didn't mention that during that year, I only took a $30,000 salary from the company, just enough for me to get by on, because it was the first year of the company. And when I'm out in the marketplace, if I'm selling my labor to Michael's business or to Jason's business, I know that they would have paid me about $250,000 a year because that's what my last employer paid me. So I have reason to believe this. So I gave up then $220,000 of income that I could have had I been working for someone else. So I would have to take that opportunity cost of the $40,000 that I could have gotten on the $2 million investment that I know I could have gotten. I don't just think I could have gotten it. I know I could have because interest rates on CDs and treasuries are that reliable. And that $220,000 that I didn't get by working with Jason or Michael, or that I could have gotten had I worked for them because I know that's what employers have been paying me in the past. And the sum of those two, or $260,000 combined, were my opportunity cost. So economic profit is our accounting profit minus our opportunity cost. So when Matt walks in and tells me, congratulations, $100,000 profit, I hit my head on the table because I know that what I really did as an economist is I experienced a $160,000 loss. Well, this all comes to thinking about economic profit from the standpoint of our company. And I don't want to think about numbers for a moment, even though numbers are in front of you. But I want to think about a relationship, and that is ROIC minus WACC, or return on invested capital minus weighted average cost of capital. If the return on capital is greater than the cost of capital, then investing will yield an economic profit or a nice profit for us, right? I can very easily help you see this. Andrew, let's suppose that I gave you an investment opportunity that you decided to invest in, but you didn't have the money to invest in it, but you knew you could borrow it from the bank of Mario. And Mario loaned you money at 7%. And so that becomes your cost of capital, right? And as it turns out, you received 10% in your investment experience. So the difference between those, the 10% would have been your return on capital, the 7% was your cost of capital, and the difference between those is 3%, right? And if you invested $1 million, if we call that your invested capital, then your economic profit would be that $1 million times that 3%. You're a happy guy. Well, that's one of the easiest ways of thinking about that. We're going to look at return on capital and cost of capital with a lot more detail and not nearly that level of simplicity, but that's a concept that you can probably fairly easily get your head around. So when the cost of capital is less than the return on capital, investing makes sense. When the cost of capital is greater than the return on capital, investing doesn't make sense. Okay? Just try to get that to settle into your minds and keep it there.
Hey, Rick, on that last slide, just a
Yes.
quick question about that equation. So just to make sure I follow. So, economic profit and then equals, and that's just the sign for economic profit, equals invested capital times your ROIC minus your WACC. And then it plays the numbers out. But then when it gets to the 0.8388 equals 21.611 minus opportunity cost. Where'd you get the 21.611?
Got it. So hang on just a second. I think I can tell you. I was afraid you would somebody would focus on that because I really don't spend more time in this course with that. So
if it's not that relevant, we don't have to cover it. I just anticipated having to do this calculation.
Yeah, you're not going to have to do the calculation, Matt. And if we have time, I'll come back to this.
Okay. Yeah, no worries.
There's some reverse engineering that goes on here. So let me see. I think that it is it's my spread. But if we get time, we'll come back to it. I don't immediately remember that. But I'm doing some reverse engineering here.
Yeah, that's okay. If it's not relevant, no worries.
Oh, excuse me. I remember. Okay, so we came up with this economic profit of 0.8388, okay, by using this equation. Well, I know that if that's the economic profit, I know that my accounting profit minus my opportunity cost is my economic profit.
Okay, I gotcha.
So in this case, the 21.611 was my accounting profit. And so I then use that structure and reverse engineer to calculate my opportunity cost. You're not going to be responsible to do that. I think I put this in here because the last time I taught this, somebody was curious about articulating opportunity cost. And this is one of the ways you might choose to do it, although I won't hold you accountable to do this. So it's a bit esoteric, if you will. If you're an economist, you're all over it. And if you're not, well, that means you have a personality and an actual life. Okay?